What if I told you real investing lessons come from mistakes, not success stories? Benjamin Graham loved case histories because they show how real decisions play out, warts and all. In this video, we'll walk through instructive company case studies and side-by-side comparisons that reveal the investor's 3 best tools: careful arithmetic, healthy skepticism, and merciless attention to risk. Read closely. These examples will change how you evaluate any stock. Chapters 17 and 18 are where Graham stops lecturing and starts showing his work. Chapter 17 furnishes several deeply informative case histories, companies that illustrate common errors investors make and the practical consequences of those errors. Chapter 18 expands this approach with a systematic comparison of paired companies, so you can see in parallel how similar headlines hide wildly different realities. These chapters are blueprints. They teach how to think about businesses, not just what to think. Graham believed the classroom of markets is best taught by example. In Chapter 17, he pulls apart 4 companies' stories to show common traps: over-leverage, optimistic accounting, neglect of balance sheet reality, and the danger of extrapolating recent gains into forever growth. The point isn't to berate the past, it's to show patterns you can use to avoid the same fate. The first theme Graham emphasizes is the illusion created by short-term growth. A company can show sparkling quarterly results driven by acquisitions, one-off windfalls, or favorable accounting. But when you pull back to multi-year data, the underlying business may have weak margins, poor asset backing, or structural problems. Graham's first case warns, don't confuse headline growth with durable earnings power. Treat sudden jumps as hypotheses to test, not proof of a new, permanent reality. The second frequent mistake is leverage. Debt magnifies returns when things go well, but it also magnifies losses and shortens runway when they don't. One of Graham's histories shows a firm that looked fine on profit days, but folded quickly when earnings dipped and creditors demanded repayment. The practical rule? Always convert leverage into a concrete refinancing and coverage test. Could this business survive 2 bad years without default? If not, its stock isn't a defensive buy and deserves a much larger margin of safety to be enterprising worthy. Dividend payments look comforting, cash returning to shareholders. But Graham's case studies show dividends funded by asset sales or one-off cash flows are not the same as dividends paid from recurring earnings. A company paying a dividend out of asset sales is slowly cannibalizing its capital base. When you see a generous payout, ask, is it sustainable from operating cash flow? If not, treat that payout as a warning signal, not a reward. Graham's case histories frequently direct you to the footnotes. This is where the accountants disclose leases, guarantees, pension obligations, and awkward one-off items. One firm in the cases only looked healthy until you read the footnotes and saw material contingent liabilities. Footnotes are not tedious extras, they're where the truth often lives. Read them like a detective. Each case ends with a crisp lesson. Require multi-year evidence, prefer conservative balance sheets, distrust shiny one-offs, and build concrete tests, interest coverage, current ratio, working capital buffers, into your checklist. Graham doesn't promise perfection. He promises a method that tilts odds in your favor. That method, rooted in arithmetic and skepticism, is the entire point of these case histories. Show each case as a short file sequence. Headline: 3 key metrics: balance sheet snapshot, earnings trend, footnote highlight, conclusion, Jock's rule. Use subtle sound hits when revealing the lesson card for each case. Seeing 2 companies side by side is like holding 2 X-rays next to each other. Differences that were invisible alone become obvious. Chapter 18 presents 8 pairs of firms and compares their financials, market prices, and behaviors to demonstrate the payoff of methodical comparison. The exercise trains you to ask the right relative questions. Which business is more stable? Which balance sheet is sturdier? And which price gives you a reasonable margin? Graham's comparisons emphasize a fixed set of cross-checks. Balance sheet strength, current assets versus current liabilities, long-term debt versus working capital, earnings record, multi-year averages, volatility, and dependence on one-off gains, dividend record, continuity and source of payout, valuation measures, PE, averaged, price to book, and price versus net current asset values. Industry and competitive context, cyclical exposure, capital intensity, and business durability. By looking at these elements side by side, you can see which firm is priced for perfection and which is priced for failure, and decide which one offers real value. In one pair, Graham compares a high-flying, high-multiplier company whose growth is recent and acquisition-driven to a stodgier firm with steady cash flows and a long dividend history. Emotionally, the high flyer attracts attention. Analytically, the steady firm often offers a better risk-reward trade-off if priced reasonably. The comparison forces you to choose between paying for expected perfection or buying proven durability. Another pair contrasts cyclical companies, whose earnings swing wildly with commodity cycles, against defensive businesses with steadier demand. The cyclical firm may look cheap during a trough, but you need to ask, is that trough structural or recoverable? The defensive firm may never be thrilling, but in portfolios aimed at preservation, it often wins by avoiding sudden, permanent capital loss. Comparison highlights which of the two you want in your specific slot: enterprising contrarian trade or defensive core holding. Paired comparisons also reveal how the market treats similar businesses inconsistently, sometimes overvaluing one and undervaluing another for reasons that have little to do with underlying economics. This inconsistency is the source of opportunity for disciplined investors. Buy the undervalued cousin, sell or avoid the overpriced one, and let time and fundamentals do the rest. Graham's pairs provide dozens of examples of this phenomenon. Use this simple workflow when you face choice between two stocks. Put the two companies in a side-by-side template: balance sheet, earnings, dividends, valuation. Normalize earnings, 3 to 5 year averages, and adjust for one-offs. Highlight leverage and near-term maturities. Check footnotes for contingencies and off-balance exposure. If one company is both stronger and cheaper on conservative metrics, that's your candidate. If not, demand a clear, documented reason to pay a premium. Here are the most actionable lessons you can use immediately from these chapters. Case histories reveal patterns, not single rules. Study them for repeated mistakes, leverage, one-off dividends, and footnote surprises. Use the cases to build rules you actually follow. Always normalize and compare. Use multi-year averages and compare companies side by side. Many investment mistakes come from treating isolated numbers as truth. Balance sheet health beats headline growth. When in doubt, choose solvency and sustainable cash flow over ephemeral growth stories. Footnotes are your early warning system. Lease obligations, guarantees, and pension shortfalls often live in the footnotes. Read them first when you want the unvarnished risk picture. Compare to find mispricings. The market often values similar businesses inconsistently. Systematic paired analysis helps you find where the odds are in your favor. Which case history lesson surprised you most? The danger of dividends funded by asset sales, or the hidden sting of contingent liabilities in the footnotes? Drop a comment with one company ticker you want me to compare to a peer, and I'll pick one for a live side-by-side walkthrough in a future video. If you'd like a downloadable comparison template, type template in the comments and I'll add it to the video description. If this helped, like and subscribe for more breakdowns of classic investing wisdom turned into practical steps. Next video will take one pair from your comments and do a line-by-line comparison: balance sheet, earnings normalization, footnotes, and valuation, so you can see Graham's method in action. Say, compare in the comments to nominate a ticker. Thanks for watching. See you in the next video.